Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be looking at Target and do a stock analysis on them. But before getting into the stock analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do stock analysis videos, so if you like looking at individual stocks, want to get good ideas of potential stocks to buy, value traps to avoid, make sure to subscribe to the channel, and of course, like the video. And if you do want me to look at a stock, leave it in the comments below, as a lot of the videos I do are based on subscriber requests. So basically getting in the Target here, this is a stock that a lot of value investors have been getting interested in. So we're going to basically see, is this actually a value buy right now? Or is it a value trap? Since, previously as in 2021, it was trading over $260. It fell to a low of under 100 and it's currently up to 129. So we're going to dive in and basically see what's going on with Target here. We can basically look at a few of the top level metrics. The group focus value band can be somewhat predictable for predictable companies, and it's saying right now Target could be potentially fairly valued. And we can see right now Target is sitting at a PE of 17.25 and has a forward PE of basically 15.63. And they do have quite a healthy dividend right now of 3.5% with a payout ratio of 0.57. So for those dividend investors, we also are going to be discussing basically is if their dividend is safe or not. So basically, let's dive into the 30 years financials now. And you can see on the right here, the chart, this is the blue line is the average revenue trend line, which has been 5%, but based on the current, basically, the green is the realized one, and with going forward in the blue here is basically, or at least the blue background, is the analyst estimates. And you can see this is basically expected to be below the 5% trend line. So Target, their revenue actually has plateaued over the last few years. And while analysts do basically expect it to pick up, they are expecting it to pick up at a lower trend rate than it has been before. So when we look at these numbers, such as their 10-year growth rate basically being 8.6%, we have to look at into the context that they're probably going to be growing slower in the future. And their EPS basically has actually grown a little bit slower at 7.1%, which I'll get into why that is in the financials. So the first things to basically look at, you can kind of glance at the return on invested capital and the weighted average cost of capital. And the one thing you can basically see is their return on invested capital has been creeping down a little bit. It's now basically under 10%, where the weighted average cost of capital basically has been creeping up, which isn't very good basically if they're trying to expand. But for a company that's now kind of plateaued in the revenue, it's not going to be the most relevant factor. But you kind of do have to factor this in for any types of investments they are doing to basically try to grow the business, that they don't get the best returns anymore. And we can see on the revenue here, well, they were growing a lot in the past, basically since 2022, the revenue has actually more or less been flat. It actually went up in 2023 and then basically started declining. So this is quite a little bit of a different growth trend that there basically has been in the past. Well, there has been these periods where they have plateaued for some years in the past and then did reaccelerate. You kind of do have to think, is that going to basically be able to happen in the future, or is there some other warning signs that they may be on a lower growth trend going forward? And when we look at the gross margin here, we can kind of see a little bit of this story developing, is that in the past they were maintaining around the 30, and you can see close to high 29% basic gross margins, but then in 2023 it actually dropped below 25%, and they really haven't been able to recover, now sitting at a 28% gross margin. And you do have to think in terms of competition. Basically, big retail stores, a big competitor for them, for example, is Walmart, which I think has a very similar basically products offerings of them. And Walmart's gross margins are actually sitting around 25%. So I still do see the potential risk of basically Target getting their gross margins squeezed down. And it does seem that, well, they have tried to maintain their gross margins basically going back up from 2023 here. You can see it has been at the cost of revenue. And a lot of basically examples I get when companies do start slowing down or even potentially dying is they basically start losing on basically the revenue front or the gross margin front or the operating margin front. One of those usually has to give. So if you want to maintain your gross margins, well, that means you're going to be getting less revenue and, therefore less EPS and sales, basically, profits at the bottom line. And that's currently one of the decisions that Target's made to try to maintain their gross margin up a little bit. They basically sacrificed the revenue growth a little bit. So this kind of does show that there could be some early warning signs of the decline of basically Target here. And then we look on the operating margin. Basically, that's the other problem that develops when you basically are still, having to grow, well, not grow, but you basically are sacrificing your revenue to maintain your margins. Typically, inflation is going to up your employee expenses, which is going to eat into your operating margins. So even though basically you're able to maintain the gross margins, what we can see here that's basically been happening with Target is it's been slowly chipping away at their operating margins. When we go in the past year, they're around maybe the 6, 7, even 8%. They're now down to about 4.49. And you kind of have to put this in context again of the competitors, basically like Walmart, where they do sit more in the 4% range. So there even is some potential downwards room that basically could happen on Target, since I think someone like Walmart has better economies of scale than Target. So there actually could be a little bit more operating margin decline for the future, basically, for Target, in my opinion, based on this trend that's developing and kind of the story we're starting to see of that they're basically declining a little bit in revenue because they're trying to keep their gross margins up, but the selling and general admin is increasing at the same time, which basically is squeezing down those margins. So we could see a little bit of basically pressure in the future. And what might happen is they could basically start stabilizing a little bit more at what Walmart basically has for their margins, or potentially even a little bit lower, since they're not quite as a big operation, doesn't have those same economies of scale as Walmart. And we can see their interest expense, they actually over the longer term, they actually have brought it down over 10 years, which is good. It's sitting at 447 million. And I usually like to basically say you have a good interest to operating income ratio if you have 10 times more operating income than interest expense, which they're just at about right now. So they're kind of at that safe level, I would say, but it doesn't honestly give them a lot of wiggle room if they needed to take a lot of debt in the future. But anyways, that's just something to keep in mind, that it is kind of that bare line of being safe. So that is okay. And when we kind of go down to the bottom line, you have to remember basically there was tax cuts in 2017 and 2018, which is basically helping boost the net margins at the end of the day. And the net margin is sitting around 3.24%. And this basically has declined from previous levels where they were sitting more around 4%. And one of the things I would be basically worried about is this could be squeezed down a little bit more in the future, since I think Walmart, we can actually just check them right now here. I just want to show you the actual comparison because I think it's very relevant. So in comparison, you can see that basically Walmart, like I was saying before, has gross margins around 24%, operating margins around the 4% level, as you can basically see here. And that's leaving them the net margins more in that 2-3% range. So I think that is something that you kind of have to factor in, that Target could be pushed down to those levels or potentially a little bit lower, since Walmart has those levels and they're growing a lot faster, which basically, well, not a lot relatively a lot faster. It's not that Walmart's growing super fast, but they do have their online kind of more commerce platform a little bit more developed, basically in as more of a competitor to Amazon, for example, than Target. So Target is falling a little bit behind in those areas. So I do think that these net margins potentially do actually have more downside potentially to them, since we kind of see they've been squeezed over the last few years now, and there is the obvious potential they could basically be squeezed more from developments we're seeing, that what we're seeing here in the gross margins, the operating margins, they are losing a little bit of their competitive moat, which largely is to their biggest competitor, which is Walmart. So looking onto the balance sheet here, you can see their total current assets basically sitting at $18 billion with total current liabilities of 19. So current ratio is fine. It's, for large companies like Target, it doesn't matter if they have a little bit higher total current liabilities. And then we can see basically total assets sitting at 58 billion. And there's not a lot of intangibles overall. It's mostly just like, plant, property, equipment. And that basically is leaving them some total equity, which, kind of should be somewhat factored in of, this $16 billion. So they are sitting on a relatively healthy balance sheet because their long-term liabilities are relatively low. As we can see, they have $14 billion of long-term debt, which is a manageable interest expense right now, and that has been brought down over the last few years. So overall, I think they're the balance sheet's sitting in fine condition, although kind of do have to remember for these retail stores, when you have a lot of these current assets, which are gross property, plant, and equipment, it's not something that necessarily gives you easy, cash flow. These are, the physical stores they have and the equipment basically, and shelves, everything that are inside. We go to the cash flow statement here. And one of the things I always like to look at and point out is look at the cash flow from depreciation and compare this to the purchase of plant, property, and equipment. Since typically, if you're growing, it's okay for these numbers to be higher. But you can kind of see a lot of these years, actually, Target is having quite a bit higher purchase of plant, property, and equipment than their basically cash flow from depreciation here, which for a non-growing company is a little bit concerning. This also could be indicating that the assets on their balance sheet, this total equity here, is a little bit overstated since, well, it's not accounting fraud or anything. There is depreciation schedules for assets, but if they actually do exhaust them earlier than the depreciation schedule and they have to repurchase, that typically does mean that, the equity we're seeing could be a little bit overstated. So I think that's something you have to basically keep in mind. And this is also affecting their net income as well and making their net income basically look a little bit higher. Since when we basically take off the depreciation from their net income and look at more of the cash flow, they're having to do more in replacements than they're actually depreciating each year for the net income. So the net income we're seeing, in my opinion, is actually a little bit lower since, well, 1 year in 2025, they did kind of match the purchase of plant, property, and equipment to the cash flow from depreciation. You can see basically in the year ending 2020, January 2026, it was 600 million more. In 2024, this was $2 billion more. Here we were almost $3 billion more, 900 million there. So you can see it's been a consistent trend for the last few years of actually spending quite a bit more of the purchase of plant, property, and equipment than the cash flow from depreciation for a company that's actually declining a little bit in revenue. So that's not a good sign to see overall. But they do have reasonable free cash flow, still sitting at about basically $3 billion in the last year, and their cash flow from dividends is $2 billion. So by all means, this is an affordable amount, and I would not be basically expecting any dividend cuts. And even if their margins were to be squeezed a little bit and their cash flow basically were to drop, they still could afford this dividend overall. So I wouldn't foresee basically Target having any dividend cuts basically going forward in the future. But basically, if that were to happen, that would mean that they're not going to be able to basically repurchase stock. And, that's already starting to happen a little bit. You can see in the last year, basically, they only repurchased $158 million of stock. And compared to previous years like 2023 and 2022, when the stock was a lot higher, they actually purchased back a lot of stock. So that's a little bit disappointing to basically see. And I forgot to basically just point out that the stock-based compensation, that there is a little noticeable amount here close to this $300 million mark. So you do have to repurchase a little bit of stock just to offset this, to basically keep the share count even stable. So basically right now in the last year, this has actually meant their share count has probably increased a little bit, which if we go basically up here and look at the shares outstanding, that's basically, what you can kind of see is that, it's slightly, well, it's more or less basically offset each other on the exact schedule, basically it's being. So over the longer run, they were buying back a lot of shares, but this activity has been slowing down quite a bit. As you can see in 2023, they had just under 465 million shares, and they've only reduced this to 455 million shares. So that is kind of one lever they're going to kind of be losing potentially, is they don't really have a lot of free cash flow left to basically repurchase shares, because they've kind of already allocated so much to the dividend. And it's very unlikely that dividend companies are ever going to cut their dividend, because that sends a very negative signal basically to the market. So if basically the summary of that is that you're unlikely to see a lot of basically share buybacks, especially if their operating margins get squeezed a little bit more, because they're going to not cut this dividend, and they don't have a huge basically buffer from their free cash flow they've had basically in the last year above the cash flow from dividends. And they could repurchase up to $1 billion basically of stock, but if we compare that to the market cap, $58 billion, that's not necessarily a huge amount. And again, we have to kind of also consider that, well, on the $58 billion market cap, they do have $16 billion of equity. This could be largely basically overstated, since the cash flow from basically depreciation is quite a bit smaller than the purchase of plant, property, and equipment, meaning kind of their assets are having to rebuy quicker than they probably should for a company that's growing in their state. So let's get into the relative valuation now. So we'll pop up basically the revenue with estimate based on their guidance and analyst estimates. And you can see, like before, it's been decreasing for the last few years, but they are actually expecting it to start ticking up again. But the key thing to note, this is like at a very slow rate at maybe 3%. So really analysts are really expecting this maybe to grow at inflation. And for a company that basically already has been in decline, this is just declined the last few years, this really isn't based on anything concrete. It's not actually a very positive estimate by the analysts when you're saying, oh, they've been declining the last few years. We think they're going to, just start increasing at inflation again. So it doesn't actually mean they're going to be increasing in revenue again. we could actually still see them plateaued for a little while longer, basically, kind of from the previous trend and combining that with how analysts usually do their forecasts. And then we can basically see the EPS with estimate here. They are expecting basically the EPS to potentially pick up at a higher rate. So this is actually expecting them to regain some of their margins again, which I kind of think we went over before. Well, it is possible. I actually almost would expect to see a little bit potentially more pressure on the margin. So I think these estimates here by the analysts potentially could be a little lofty just based on the current state of basically Target and how they're sitting. So let's get into the relative analysis here. Basically, you can bring up the price to sales. I'll take off the revenue at the same time here. And you can see that it did, oops, need to get the price to sales back up here. There we go. You can see it's at 0.55, which is historically basically at lower levels. But I think it's very important that you always take this in context basically of their margins. So we're going to take their operating margin, and you can see basically the problem that's been starting to develop with Target is their margins, especially the operating margins, have been basically declining over time, basically at least since 2008 here. 2007 actually, there has been basically a downtrend for the margins. And I'm not too optimistic that we're going to see basically a rebound compared to how well Walmart has been doing. If anything, we're probably going to maybe just like stabilize in the margins, in my opinion. So that actually would probably garner a lower price to sales ratio than we have basically seen in the recent past. And let's look at the net margin, but because of the tax cuts, doesn't give us quite as good of a view of the overall trend. And even within that margin, you can see that basically it's been starting to get pushed down a little bit. Even those tax cuts that helped bring it up, it basically has been having some negative drivers basically towards it. And the next thing we're going to do is pop up dividend yield. And let me just find where that is here. Dividend yield. And historically, I would say when you do reach these higher levels here, it has been a good time to buy, and that at least has served well for the short term. But I think there is a little bit basically changing with Target, as I've been saying, that they're kind of starting to potentially enter this decline phase based on the revenue staying flat and dropping their gross margins, and their operating and net margins falling as well. So we're going to take a look at the P ratio. They're sitting at 17 right now, and typically the lows they've got to is maybe 10, a little bit below 10, and the highs here was like 17 up to 22. It's not a stock that actually trades at very high multiples overall, and I think 17 basically P for Target in its current state with the lack of growth happening is probably a little bit on the upper side. So I put this into my little, it's not a discounted cash flow calculator, it's a discounted basically earnings estimation calculator. And if you take the analyst estimates, which I already think are basically a little bit aggressive because they're assuming that the net margins are basically going to recover and we're going to be having that at least 3% growth, and that's basically 1109 by the end of 2030. And if we took the PEs of 15 and 20, which I think this is a reasonable range, or even the upper range that basically Target should trade in, are basically growth rate or returns we would get if we bought the stock now would only be around 5.7 to 12.5%. So I think that is basically extremely low for Target, especially the risk you're getting. We can kind of see in my chart here, a little kind of longer term trend with a little bit of technical analysis. I've kind of marked this level down here, this 53, where we do have the price volume profile. And I do think there is a good probability that, Target does eventually basically trade down to these levels. Well, there was a temporary good bounce basically at this level here. You would have basically wanted to see the fundamentals improving as well if this was going to resume this trend. But I think there's enough signs that have developed over the last few years that this previous trend basically of growth and the higher margins are basically not going to continue, as we're seeing the declining margins and we're seeing lower growth at the same time. So if we start targeting more of a level, trending down to about $54, you can plug that in here, put in 54, and then you can see that actually does start turning into potentially a more attractive place to purchase Target, because then even if you were to only be targeting a 15P ratio in the future, which even could be lower, you still actually get much more reasonable rates of return that basically could be achieved. So from that, you can basically see that I think Target right now is potentially sitting a little bit of a value trap. there really hasn't been any very much positive improvement over the last basically few years. And even if they were to achieve the analyst estimates and basically recover those margins a bit and resume on a reasonable growth trend, we wouldn't overall basically be looking at, let's get that, a very attractive return at this price. So anyways, I think Target is currently sitting at the value trap stage, although like a lot of stocks, I keep them on my watch list, and they do have a relatively healthy balance sheet. And if they were to ever come down more to this level, which is not going to be very quick, that's probably when I would personally be getting interested in the Target. So anyways, you can leave me your thoughts in the comments. Remember to subscribe to the channel, like the video, and I will see you in the next stock analysis.